It's a great pleasure for us to be with you. I'm Bobby Coates, a professor in the Department of Agricultural Economics and Agribusiness in the University of Arkansas System's Division of Agriculture. In today's webinar, Texas A&M's Dr. John Robinson on the cotton market and risk management outlook. Dr. Robinson is a professor and extension cotton marketing specialist in the Department of Agricultural Economics at Texas A&M University. As a cotton marketing specialist, both domestically and globally, Dr. Robinson has few equals. John's current research and extension cotton marketing program emphasizes risk management issues related to cotton, including cash markets, hedging, contracting, insurance, policy, and transportation logistics. Now, Texas A&M's Professor John Robinson on the cotton market and risk management outlook. John, we look forward to your presentation.
Bobby, thank you very much. It's a pleasure to be here. I appreciate the opportunity to visit with you and share some thoughts about the cotton market. So how I'm going to proceed is by following an outline of these slides, the first part of which will be a market outlook. So I'll examine supply and demand emerging issues, and then I'll spend a little bit of time at the end talking about some risk management considerations. What I mean by that are specifically some tools to help people evaluate their crop insurance choices, and also just a little bit about some tools to help with the very current issue of policy sign up for cotton. So just to begin with, I've got a slide up here showing USDA's current estimate, the November estimates of U.S. cotton supply and demand. The numbers are in the right-hand column, and what they show us, basically I would describe the last report as accounting for a number of the major late season changes that we've had, and I'm thinking specifically in terms of the hurricanes that hit the Carolinas and Hurricane Michael that hit Alabama and Georgia in devastating fashion. Those production losses were, I would say, partially accounted for in this WASDE report that came out, but I wouldn't be surprised to have the next report, maybe the next two, still whittle away at the U.S. production estimate as USDA figures out how many bales were actually lost during those storm events. But the main issue related to these supply and demand projections, I think, going forward is the demand question. Is demand slowing, or are we just in a temporary lull? So I'm going to spend some time dwelling on that demand question. And then lastly, what are the carryout stocks that are going to affect the balance sheet for next year's crop? So let me begin with some demand considerations that are going to basically go very broad and then narrow down. So I'm going to talk a little bit about the things that influence the demand for cotton, basically by asking the question, how's the general economy doing, and how is the likely demand for apparel and home furnishings increasing, staying the same, increasing, or decreasing? So I'll consider that. And then I'll focus a bit more on U.S. exports, and then some other influences or indicators of the demand for U.S. cotton exports. So unlike we think of grain crops, we think of food crops, the consumption, the demand for grain crops has been largely unaffected by things that affect cotton demand, mainly because the issues in the world, there is a growing class of people who are becoming wealthy in some of the developing countries. And the first thing they do is start to improve their diets, eating more grains and eating meat, grain-fed meat. And that's led to a major expansion, upward trend in per capita grain consumption. That's not true of cotton. Cotton is more of an industrial crop, and it's related to retail purchases of apparel and home furnishings. And those go up and down. They're discretionary type items. and they go up and down with the economy. So I'm showing here a chart of economic growth, basically, of developed countries like the US and Europe, and of developing countries like India and China and other countries, and then the world GDP. And you can see some big upward zigs and zags there. When things are in a boom and when economic growth is growing, per capita consumption of cotton goes up. And when we're in a major recession, per capita cotton consumption declines. What this chart shows you is that basically we've been in a bit of an improvement. So you think of the last 2 years and the way the economic growth has been over 3% in the United States. The stock market was doing well up until a few months ago. So we were in a bit of an improving situation, but now the stock market is kind of reset somewhat. There's, people talk about whether there's a chance of a recession, a chance of slowing. I don't know the answer to that, but I would basically say we're not in a boom time, and the longer term projections are for somewhat slower economic growth is what this chart shows. And so I'm not looking to a major, boom in economic growth and in people's wealth to stimulate large purchases of, more cotton than we were expecting. Okay, so I'm not seeing that out of this particular forecast. So let's look at just a little bit more specific. Well, here's a chart that shows what happens when we do have recessions, which are the tan bars here. And what you mainly see is historically per capita consumption of cotton drops, because when people tighten their belts, they don't have to buy new clothes, they don't have to buy new towels and sheets, but they do have to buy gas and put food on the table and gas in the car. So people prioritize, and so it goes to that question: what kind of an economic pattern are we in? And the answer to my mind is mixed. I think we're in a mixed, broad pattern, and so we'll just have to see how it plays out. Here's a more direct picture of demand for U.S. cotton. This is a picture of exports as a function of price. Exports are the peaks and valleys of shown by that blue line there and measured on the left-hand scale, and price is the red line. And what I want to show with this, well, first of all, in general, when price goes up, the quantity demanded of our exports drops. That's what an economist would expect. But what I really want to show with this slide is that we were in a period back in the spring of outstanding, unusually large, unusually early export sales of the 18 crop. Were going on from January all the way through about June. And that was a pattern that was adding to the bullish sentiment that was already in the market, because at the same time, the market was worried about a drought. Now, it's been so wet, we've forgotten about droughts, but there was a major drought going on in Texas and Oklahoma and Kansas and other parts of the Cotton Belt. And so between concern about supply and rather strong, sustained, robust export sales, things were looking pretty good. And that's when we had prices rally steadily all spring, all through the first and second quarter of the year, on up into the 90s for a while. Well, the pattern of unusually large export sales has turned around. Starting in June, it's slacked off, and now we've been in a recent pattern of somewhat anemic export sales. So what to conclude from that? I would associate some of it with the China tariff uncertainty. I'll talk more about that a little bit later in the presentation. But there's other things going on too. I think export sales business has been hampered by problems in Turkey that are, I would say, a little bit unique to Turkey. They've had political upheaval, their currency has collapsed, their trade has been disrupted, and that's probably curtailed what otherwise would have been normal sales of U.S. cotton to them. And then the problems with the crop and the uncertainty of the quality supplies, I think may have put a damper on U.S. exports. So there's a number of things going on, but we've gotten away from the period of what was robust, strong indicators of demand in terms of U.S. exports. I'm going to put another slide up here that's going to show exactly the same thing using slightly different ways to express oneself. What this chart shows is U.S. exports or U.S. total commitments of cotton to be exported. And the black line there is for 2000 to 2018 crop. And again, the black line being above the other lines basically is indicating that we were at an unusually high amount of export sales early in the year. Now, had that continued, that would have been an indicator that, shoot, USDA's guesstimate of 15 million bales of exports is way too low. I mean, if we're starting off only a couple months into the marketing year and we've already sold over 60% of the cotton that USDA projects, well, maybe USDA's target is too low. Then on the other hand, the recent anemic export sales may simply mean that we front-loaded a lot of sales and they'll return to normal and will hit USDA's target. Again, that's something that we'll have to see. This shows just simply how strong things were early in the year, and where we go from here remains to be seen. I have one more slide that shows exactly the same thing. This is some other information that the federal government puts out. The first column of all these numbers basically are numbers of contracts. I would call them basis contracts, on-call contracts between merchants and mills that have yet to be fixed in the futures market. You could think of these as contracts that have been sold for future delivery. They haven't finalized them yet. When they do finalize them, I'm expecting the hedges, short hedges on these numbers in the first column, they reflect short hedges that'll be bought back. And these are large numbers. These numbers historically are in the top 20% for this time of the year. So these are large numbers. Again, they reflect the large amount of business that was conducted up to this point. And that's still a bullish thing. Hopefully this won't be undone by cancellations of these, or continued cancellations of these contracts. And hopefully business will pick up again. But this shows the amount of business that's been done up to this point. And it shows me something that may be a bullish indicator later next year, when the March contract is about to expire, or the May or the July. I might expect a little bit of little flurries of buying that may hit the market in terms of giving us, we come and look and it's 2 cents higher that day. That might be indicating that a lot of these mills are fixing prices that day and futures are being bought back. Or the flip side of that is if there was a downtrend in the market during these time periods, the mills might rush to fix a lot of contracts at the lowest prices that they could, and that would temper what otherwise would have been a drop in the market might be tempered by the buying that's embedded or implied by these numbers right here. So that's something to watch. That's a little bit encouraging on the possible pattern of those old crop futures contracts. Here's another influence. I'm showing a slide of index fund and hedge fund buying and the influence on prices. The index fund buying is indicated by this blue area, and it's measured in terms of thousands of cotton futures contracts held by these funds in blue that tend to be buy and hold type of investors. They tend to be a little bit divorced from cotton economics, from agriculture. They're looking at commodities broadly as an alternative investment to stocks and bonds. And so they tend to buy and hold according to formulas. So they're buying and holding quite a bit of cotton futures, somewhere pushing 80,000 or 8 million bales worth of cotton futures contracts are held by these guys in blue. The ones I'm most interested in, and the ones I guess I'd say that are more of an influence on the upward and down movements of cotton prices, cotton futures, are these speculators that indicated by the green areas. Those I would call hedge fund trend following types of speculators. If they think the market's going down, they'll sell it, trying to take advantage of that trend. If they think the market's going up, they'll buy it. And they tend to be a catalyst, and they tend to sort of be a self-fulfilling prophecy sort of influence. Well, if you look towards the right-hand side of this slide, you'll see that going back into 2016, we've had varying but large positive amounts of net buying by these hedge fund buyers. And just more recently, during 2018, the rise in prices that we had all during the first and second quarter of the year, the peak in prices that we had in the mid-90s, are associated with a major buildup of hedge fund longs. And consequently, when those people downshifted out of that peak position, that's when prices came back down into the 80s and then below 80 cents to where they are today. It's 70, 77, 78 cents per pound. So they're a major influence. The last major downshift was associated in time with some of the more recent announcements about tariff retaliations between the US and China. So I think it had something to do with the mindset of these speculators in getting out of that uncertain situation, which contributed to a decline in prices. A couple of emerging issues that I want to touch on that have been on the minds of a lot of people for many months. One would be the situation in India, and then what I've already mentioned, the situation between the United States and China. So the Indian situation may have been somewhat resolved, but perhaps not fully. And basically, it's a situation where USDA was counting more bales of Indian stocks and historical stocks than the market thought had ever been there or were there. And there was a lot of clamor by a lot of knowledgeable analysts suggesting that USDA needed to revise their balance sheets for India lower. And back in about October, USDA finally got around to doing that, and they cut 2 or 3 million bales out of the Indian balance sheet going back a few years, and that tightened up the world stocks number. And I think that was already priced into the market, and maybe there's a little bit more of it to come. But anyway, that's just one of the things that we deal with when we're talking about a global crop and trying to account for international forces. The tariff situation that I've already mentioned is something that at first I didn't really expect to have a direct impact, a reduction. I didn't expect it to have a reduction on US cotton exports. And that's mainly because if China, which they have, imposed a 25% tariff on US exports of cotton, then based on the last 5 years of history, when they've distorted markets previously, it didn't reduce our exports, it just rerouted them to other countries where spending increased, like Vietnam and Indonesia and Bangladesh, and even Pakistan and India. And I expect the same thing to happen if it persists, that there's a 25% tariff on US cotton exports to China. I would expect our exports to those other countries to go up, and they will spin that US cotton into yarn and then ship that yarn to China duty-free, and China would get the cotton. It would just be rerouted. That was what I expected to happen. I think that's what a lot of analysts expected to happen, and probably a lot of speculators, because these tariff things hit the news earlier in the spring, and they mentioned cotton as early as April, and there wasn't a market effect at all for months. So it was as if the market was discounting the possibility of an impact on US cotton exports. And I think what the reason I just articulated is the main reason, that the cotton would still get there. Now, most recently, the last round of kind of tit for tat announcements back in September, the US imposed another large round of tariffs on selected Chinese imports, and they included apparel. Now, China's responsible for about 40% of the apparel imports into the United States, and about 30% of the cotton-dominated apparel imports into the United States. So if we impose tariffs on Chinese imports, in the short run, we're probably making it more expensive for US consumers to buy cotton-dominant apparel, and we're raising the price of it, which in theory would reduce the demand of it for it. And so that may work its way back down the supply chain to reduce Chinese demand for cotton in general, not just for US cotton, but in general, if that situation persists. So that's the maybe on the impact of US tariffs on Chinese imports. It may eventually impact cotton economics by making apparel more expensive. Now, in the long run, other countries might step into the gap and produce more apparel and export more apparel to the US, but that would take time. I've already mentioned the impact. There's an indirect impact on the cotton market, the futures market, from this tariff situation. And I think we've already seen that with hedge funds kind of downshifting out of their long positions because of uncertainty about the impact of this whole deal. And then there's one more thing to worry about perhaps, I guess I'm paid to worry about these things, but that would be the effect that all these tariffs, us on China, us on Canada, us on the EU, tariffs on Mexico, whoever, in the long run, are, I'll just say, tariffs slow growth. Tariffs are a tax on consumers. It would ultimately result in slower growth. To the extent that GDP is lower, cotton consumption is lower. So there's a kind of a big picture, long run issue there in terms of slowing economic growth that may be a concern if this tariff situation persists in time. So I'm going to shift gears now. All of the demand things that I just discussed are the pattern and pace of our exports, the growth of the economy in general. All of those things are important in considering what happens in 2019. They're still just as relevant. The main situation that colors my outlook for the 19 crop is I think we're going to have a very big supply. I think we're going to have a bigger supply of cotton to deal with than we have now. And that's because I think we're going to plant just as much, if not more, cotton in 2019. And that's because grain prices are lower relative to cotton prices. It favors cotton over wheat and cotton over feed grains. Soybean prices have collapsed, as a number of the listeners in the Mid-South are painfully aware of, and that may increase cotton plantings as a substitute in the Mid-South and in the Southeast. And then, unlike 2018, we already have excess soil moisture, and we have a forecast of El Nino conditions, which usually means rainier, wetter weather during the spring and lasting all the way into the summer. And typically El Nino situations and the moisture that comes with them is associated, at least in the Southwest, it's associated with lower abandonment, higher yields, potentially excess production. And so I'm worried about a supply response, which is economic code for weaker prices as a result of excess supplies. Let me touch on some of that. This is a chart that just shows the relationship basically between corn prices, cotton prices, and how much cotton acres are planted. The cotton acreage is on the axis here. Those are millions of acres planted. And this scale down here on the bottom, if you think of $7 corn and 70-cent cotton futures, that would give you a ratio of 10. Way off to the right somewhere, and I would expect very, very low cotton acreage if that was the situation, but that's not the situation. The ratio is about 5.1, so somewhere right in here, very similar to 2018, is where this simple model would predict that cotton acreage would lie from a historical standpoint, and frankly, that's where I expect it to be, 13.5 to 14 million acres. Some of the industry estimates that are out there are already projecting over 14 million acres. And the Informa estimate is explicitly accounting for lower soybean plantings as well as feed grains figuring into that. So we're going to plant more. And as I said, we're going to have more moisture to go with it. This is a chart showing NOAA's forecast of Pacific water temperatures. And we're here, this black dot, and they're projecting not large deviations, but persistently and long deviations of temperatures, meaning the Pacific is warmer. And when that happens, typically we get moisture flowing in from Pacific fronts that bring a lot of excess moisture, particularly to the drier regions of the Cotton Belt in Texas, Oklahoma, and Kansas, but all the way to the Atlantic seaboard. So we're going to get more moisture, more than likely, and we get larger plantings with that. It's quite possible we could have lower than average abandonment, higher than average yields. That's reinforced in some situations over in the Mid-South and Southeast regions where maybe they intended to plant corn, but if it's so wet during the wintertime, they can't get it in, and then their choice is cotton or Group 5 soybeans, and cotton may be the beneficiary of that. So here's some projections looking at the far right-hand column, and I would say, I think these are conservative estimates, but I'm guessing if we only plant 13.5 million, and that may be low, and if we only have 10% abandonment, and that may be too high, and if we only have 850-pound yields, and we could easily have 900-pound yields if we have a lot of moisture, and Texas produces a lot. and we carry in, this will be lower than it is now. So I would say if we carry in just 4 million bales and produce a crop of 21 and a half, we're going to have something pushing 26 million bales. And it could be higher. It could easily be 27 million bales. We use about 3.4 million in, I hope we use that much in our domestic milling industry. And 16 million bales of exports would be kind of the top level of exports that we've ever seen. But if we do that, we could wind up with over 6 million, which is a 2 million bale year-over-year increase. I frankly think it's kind of easy that we wind up with this situation of a 2 million bale year-over-year increase. And if that was to happen, I would expect that the trading ranges that we saw in the previous couple years where, you know, futures were basically between 70 and 85, I would see that shifted down 5 or 7 cents to where we had futures trading from 60 to 75, or maybe even below 60. I would be worried about downside price weakness that frankly we haven't seen in a couple of years. We haven't seen futures below 60 since I think 2016 sometime, and I'm a little worried about that possibility. So I just made that point, and if that outlook seems possible, then what I would ask growers do is consider the various ways they have to remove downside price risk while prices are still good. You know, we have futures in the upper 70s. I would ask growers to consider forward contracting a reliable amount, a portion of their expected production or their guaranteed production. They could use their APHs, some fraction of their APHs, and go ahead and forward contract at these levels. Or especially if we have a rally in the market, I would take advantage of rallies to do some pricing and take away some of that downside price risk. Similarly, or maybe even at the same time, you could be forward contracting a portion. You could also consider just hedging a portion and hedging earlier than perhaps you're used to doing it, but either using a hedge selling futures, which has its risks, or using put option strategies, which I'll illustrate in a second. But I would consider hedging a portion, especially if, again, if there's a rally in the market, put option strategies at a given level of prices would only get a little bit cheaper, and I would be ready to act. I would be ready to act with a relationship with my merchant buyer. I would be ready to act with an established an account with a reliable futures broker that you trust, who knows about ag commodities and who knows about cotton, and be ready to act on what might be quick bursts of upward volatility due to whatever uncertain events. When they happen, sometimes they don't last very long. When they're spec driven, they sometimes don't last very long, and you need to be ready to act. This is just an example. I'm not recommending it necessarily. Actually, you know, compared to 2018, this is a lot poorer. I'm not sure I would do this, but this is just an example of how, as prices rise, prices are the blue line here, as futures prices go up and down, the affordability of downside price insurance using put options becomes affordable and then less so, and more affordable and then less so. Most recently, with the futures market trading the December 19 contract, it's going to expire a long time from now, but it's trading in the upper 70s. A 75-cent put option on December 19 right now is trading around, as of yesterday, it was trading around 3.5 cents, which is kind of expensive. What you get for that, buying, essentially using 75 cents as your reference price, you're paying 3.5 cents outright, so you're insuring something like 71.5. You're buying a short futures position with no margin obligation. You're buying a short futures position at 71.5. You take your expected basis off of that. You're locking in a flexible cash price, a minimum cash price, somewhere in the mid to upper 60s, depending on your expected harvest time basis. Now, and then that's shown in these numbers here. Now, a minimum cash price in the mid to upper 60s is not going to cover all of your production costs. Probably, you're the one that's going to have to know that for sure. It could provide some insurance though, and another thing it could do, as early as it is in the year, your insurance price for your RP and YP policies is going to be determined sometime by the average of the December 19 contract in the month of January, or between the middle of January and the middle of February. It depends on your sales closing date. Putting on a hedge this early is actually insuring against a decline in your insurance base price before it's established. So if there was a big decline in the market, doing a strategy like this, or doing a cheaper version of it, like the put spread, buying the 75, selling the 68, or some other thing that your broker would recommend, could provide some early on insurance against just a weakening of the safety net provided by the other insurance, revenue insurance contracts. So something to consider. I've been putting those examples out in my presentations. I update them most weeks when I post my newsletter, just as examples to raise awareness that you can be taking actions. Even if merchants aren't there offering you contracts that you would like to contract right now at the prices right now, you could be taking the initiative to do this sort of hedging to give yourself some measure of protection on some share of your expected production. The examples that I mentioned of hedging, I tend to post usually on Fridays when I'm not traveling in this website here, and my opinions show up in various other places. And again, they're examples to stimulate thinking and planning. What I want to do in the remainder of this presentation is talk about, besides pricing and hedging thoughts for price risk, I want to talk a little bit about a few other risk management considerations. So one would be insurance. One thing that we've been doing quite a bit of in our meetings this fall is highlighting some available tools that you can use yourself. They're available online, and they're available at this website here, afpc.tamu.edu. That's our policy center, our Ag and Food Policy Center. And one of the tools that they have on that website is an insurance decision aid. If you go to that website, if you click on economic models and then click on some label called Farm Program and Insurance Decision Aid, there is a tool there that you can use to basically, I'll boil it down to just a few seconds, you can input all of your different operations and your APH histories and the locations, the county of those operations. And what it will do is consider all of the thousands of combinations of insurance products. If you think of yield protection, revenue protection, harvest price exclusion, times all the coverage levels from 50% to 85%, times all the other choices like trend adjustment and yield exclusion and cottonseed endorsement and SEO or NUD and various other things. This is an example from a Texas farm, but there's 8,000 or 9,000 possible combinations that could result from that, all of which cost different, all of which would result in different expected values. That's the payout of the insurance if the insurance kicks in, plus sales, market sales of crops that you sold, less the cost of buying that insurance. There's so many thousands of possible outcomes. They don't show up all. This is just a set of them. Well, what this thing will do is sort through the best ones and bring them to your attention. For example, the output of running this for a particular farm, you could click on one of these little dots and look over here to the right, and it'll show you just one detailed example. All right, this choice was a 65% revenue protection with harvest price exclusion, excluding 1 year of yield without trend adjustment, looking at enterprise units, and considering SEO as a supplemental, and various other things. And each one of these other ones is somewhat different. It's something that lets you sort through a selection of them, maybe print them out, maybe take them to your crop insurance salesperson and say, you know, for my farm, this model had a few suggestions. We've never talked about those. Why don't we talk about them? Give you a basis for asking some questions. So that's what that tool is for. The 2019 version of it will be available in I understand, in a few weeks or a month or so. So it's going to be there at that website, afpc.tamu.edu, this website, this same website here. If you go to that website, though, the first thing that you're going to see right there on the front page is something called 2018 Generic Base Decision Aid. And that's something that's germane to the Farm Bill sign-up. Just a little bit of background. You're probably all aware that cotton was brought back into Title I farm programs. They created a sort of a blended covered commodity of seed cotton, which is the combination of cottonseed and lint. And the 2018 crop is eligible to be covered either with ARC coverage or PLC coverage, like the grains. And there's some decisions to be made about allocating your generic base and perhaps updating your yields. I'm not going to get into the formulas or the guts of those decisions and the details of that sign up, but what I will simply do is point you back to this website and a tool. There's a decision aid that will help you analyze that cotton base, that generic base allocation question. It's a very important question, and you have to answer that question sometime between now and December the 7th. You also have to choose between whether you want to sign up for ARC or PLC, and there is an opportunity to update your payment yields. So I would leave you with this link and urge you to take advantage of it. And if you have any issues, even if you're not in Texas, I'm going to tell you, as a Texas taxpayer, you have my permission to call this phone number down at the bottom and ask for help in interpreting your results or perhaps inputting your data. I understand Mississippi State, my friends there have a tool that's available that's being used by Extension in Mississippi and Arkansas. So whatever tools are available, I would urge you to use them. I think these sorts of decisions are just as important as your seed variety and your herbicide regimen. These sorts of things are going to be important for years. And you're going to be living with them with whatever choice you make or whatever choice you default to.